Welcome to Chapter 3. This is Dr. Kenneth Ta. Chapter 3 is Operating Decisions and the Accounting System. In Chapter 2, we had discussed different business activity. We spoke about financing activity. We also talked about investing activity. And we spoke about operating activity. So these activities or decisions end up in the accounting system. In chapter 2, we basically saw how financing and investing activity ends up in the balance sheet. In chapter 3 is going to be the same kind of approach like chapter 2, but specifically we are going to look at operating activity or operating decisions, and we'll see how operating decisions ends up in the income statement. So this is a sample of an income statement, Chipotle Mexican Grill, and this is a consolidated statement of income, which implies that it takes into consideration all the branches of Chipotle. The income statement is usually for the entire year, so it is stated clearly that for the year ended December 31st, 2011. And the unit of measurement is also stated is in thousands of dollars. So the numbers we find on this income statement is in thousands of dollars. So what we find on the income statement is that a lot of things that appear on the statement comes from operating decision, operating activities. Operating activity is usually the central focus of the business. So the income statement will give us net income or net loss of the business. And the operating activities center around the generation of revenue, sales revenue, and the expenses that occur in the business. So when we take revenue minus expenses, we can end up with net income. Operating expenditure is outflow of cash for any purpose, such as buying equipment, paying off a bank loan, paying employees for their wages, etc., etc. So these are expenses. Expenses are outflow, they are outflow, or using up assets or increases liability from ongoing operation incurred to generate revenue during the period. So when we talk about cash expense, it could be debt payment, or it could be the buying of assets. So this is sample expenses for a restaurant business. It could be food expense, it could be salaries or wages expense, it could be occupancy expense, depreciation expense, income tax expense, etc., etc. In this chapter, we are going to focus on what we call the accounting basis in recognizing revenue. It differs from the cash basis. So the accounting basis, or what we call the accrual basis. With cash basis, revenue is recorded when cash is received. So we will say we have this amount of revenue based on how much cash that we have received. That is the cash basis. And at the same time, expenses are recorded when cash is paid. We will say there are expenses when cash is leaving the business in payment for goods or services. So that is the cash basis of recognizing revenue and expenses. In accounting, we actually do not work based on the cash basis. We recognize revenue and expenditure based on what we call accrual accounting. With accrual, assets, liabilities, revenue, and expenses should be recognized when the transaction that caused them occur, not necessarily when cash is paid or received. And the accrual accounting is required by the GAAP, which is the generally acceptable accounting principle. So when a transaction occurs and that transaction incurs revenue or liability or involve assets and liabilities, then we are going to recognize that transaction. So we'll not only wait until when there is an exchange in cash. So revenue realization process. Cash may be received at any point in time in this timeline. Cash may be received earlier, that is for a food industry before food is delivered. Cash may be received at the same time at which the food is being delivered, or cash may be received after the food is delivered. So under the revenue recognition principle, there are 4 criteria or conditions that needs to be met for revenue to be recognized. Those conditions includes delivery has occurred or services have been rendered, or if there is a persuasive evidence of an arrangement for customer payment, or when the price is fixed or determined. There are no uncertainty as to the amount to be collected, and when the collection is reasonably assured. Once this takes place, then we are going to go ahead and realize revenue. The revenue principle. We are going to look at certain type of transactions. So first we'll look at it at a more generic basis. Then we'll look at series of examples, how we are going to recognize revenue and expenses, and how we are going to journalize those transactions, and then we post them to the general ledger. So the first broad example we want to look at is if cash is received before a company delivers goods or services. So if we receive cash ahead of delivery of goods and services, that becomes a liability for the company, because you have received that cash and you still need to render service, or you still need to deliver goods. So we'll call that unearned revenue. The account that will be affected is called unearned revenue, and this unearned revenue is actually a liability. So when we journalize this transaction, it is based on the rules of journalizing, which we discussed last time. It is based on which account is affected and whether the account takes a debit or a credit balance. By that, if it is an increase in a particular account, do we record that as a debit balance, or do we record that as a credit balance? Let me remind us that last time we look at transactions under broad headings. We look at transactions that will end up as assets. Hope you can see this. Liabilities and stockholders' equity. We said for assets take a debit balance. So by a debit balance, we imply that increases in assets is recorded on the debit side. Liability take a credit balance. So increase in liability in the company will be recorded on the credit side, and stockholders' equity takes a credit balance. So increases in stockholders' equity will be recorded on the credit side. So this is very important in doing journalization and in doing posting to the general ledger. So we'll use these principles as we look at this example. We are going to add 2 additional principles that we are going to see, and it's because we are trying to see how we build the income statement. And mostly what we have on the income statement is revenue and expenses, because we know revenue minus expenses will lead to net income or net loss. So the 2 additional things we are going to put in the role of journalizing is revenue and expenses. So revenue is going to take a credit balance. So increases in revenue will be recorded on the credit side, and the expenses take a debit balance. Expenses take a debit balance. So increases in expenses is going to be placed on the debit side. So these are the rules we are going to follow as we journalize transactions and post them on the general ledger. So let's look at this example. The first example is the case for which we realize unearned revenue. So cash is received. Cash is received. Cash is an asset, and asset is increasing because cash has been received. So on this first column, this is the debit side, and the second column is the credit side. So increase in asset will be given a debit balance, and then we have unearned revenue, which is a liability. Liability is increasing, and based on our role, increases in liability is given a credit balance. So we always start with debit first, and then we record the credit side. So this is how we are going to journalize this transaction. Cash is increasing, a debit balance, liability, precisely unearned revenue is increasing, it takes a credit balance. All right, let's look at the second example. This is when the company delivers the good or service. Notice that when the company delivers the goods or service, then two accounts will be affected. We are going to recognize service revenue at this time because the good and the service has been delivered, and our liability is going to reduce. So the liability we had incurred before is known as unearned revenue. Unearned revenue. So this is how we are going to journalize the second transaction. Unearned revenue, that is a liability, is reducing. So if liability is reducing because now the company has delivered the goods or service. So when liability is reducing, it takes a debit balance, and then we have service revenue. Service revenue is going to increase. We are going to recognize service revenue. So when revenue is increasing, it takes a credit balance. So first we start with the debit balance, and then next we record the credit balance. So this is how we are going to record this transaction. Again, it is based on the rules of journalizing. We said increases in assets take a debit balance, increases in liability take a credit balance, increases in stockholders' equity takes a credit balance, increases in revenue takes a credit balance, and increases in expenses take a debit balance, takes a debit balance. So let's look at the second example. This is the case for which cash is received on the date the revenue is earned. So when cash is received on the date the revenue is earned, two accounts that will be affected will be cash and revenue. Cash is going up and revenue is also going up. Cash is an asset. When asset is increasing, it takes a debit balance. Revenue is also increasing. When revenue is increasing, based on our role, it takes a credit balance. So this is how this transaction will be journalized. So first we need to be able to recognize the accounts that are affected, and then in journalizing those accounts, we want to ask ourselves if that account is an asset account or a liability account or a stockholders equity account or a revenue account or an expense account. And we know that if it's an asset account, increases in asset takes a debit balance. If it's a revenue account like this case, increases in revenue takes a credit balance. This is another transaction. This is the case for which cash is received after the company delivers goods or services. So cash is received after the company delivers goods or services, which implies that cash will be received later on. So if a company delivers goods and services and then is expecting payment in the future, this will be an accounts receivable. An accounts receivable is an asset for the company. So accounts receivables are asset. It has future benefits. The company is expecting cash payment sometime in the future. So the goods and services have been delivered. So the company is going to recognize revenue, and this is how we are going to journalize this transaction. Again, accounts receivable is an asset. Asset is increasing, so it is going to take a debit balance. And then we also have revenue that has been recognized. Revenue is increasing. Increases in revenue are given a credit balance. So this is how this kind of transaction will be journalized. So what we are doing is we are able to recognize the account that is affected, and we are seeing how we journalize that transaction. All right, this is another example when cash is received. So if there was a transaction for which we have an accounts payable, so we are expecting cash in the future. Now, the future comes and we receive cash. So how do we journalize that transaction? So when we receive cash, the two accounts that will be affected will be the cash account and the accounts receivable accounts. So cash is coming in, cash is increasing, accounts receivable is going to reduce because our accounts receivable was there, suggesting that we are expecting payment in the future. Now, when the payment comes in, our accounts receivable is going to reduce. So we will start with the one that takes a debit balance, which is cash. Cash is increasing. Cash is an asset. Increase in asset takes a debit balance. And then we go to accounts receivable. Accounts receivable is also an asset, but accounts receivable is decreasing. Decreases in assets take a credit balance. So under revenue principles, we have seen cash to be collected. Cash to be collected, or recognize those cash as receivables. So receivables suggest that the business, someone owes the business. So customers are owing the business. So for example, there is interest receivable. So the business is expecting interest payment in the future. There is rent receivable. The company is expecting someone to pay their rent in the future. There is royalties receivable. So all of these are assets. So this is cash to be collected. Then we have also seen revenue. So this is earned when goods and services are provided. So once goods and services are provided, revenue is recognized. Not necessarily when we receive cash or when cash is being disbursed, because that will be the cash basis of accounting. With the accrual accounting, revenue is recognized when service or goods are provided. So we can recognize interest revenue, or we could recognize rent revenue, or we could recognize royalty revenue, or it could be sales revenue, etc., etc. So we have seen revenue. Now we want to talk about expense. And when we journalize expenses, it is based on the expense matching principle. The expense matching principle requires that costs incurred to generate revenue be recognized at the same period. The same period. So expenses are costs incurred. So the matching principle just simply states that in the same period for which we are recognizing revenue, the expense that is associated with that revenue needs to be recognized. So let's look at some broad examples. This first example is the case for which it says cash is paid before the company receives goods or services. So if cash is paid before the company receives goods or services, we will simply call that a prepaid expense. It's a prepaid expense. Prepaid expense, they are assets. It becomes an asset to the company because the company expects benefit in the future. So the company has already gone ahead to make payment. So when they make that payment, they can benefit in the future. So that payment is made with cash. So prepaid expense will be recognized and cash will also be recognized. So prepaid expense is an asset. Asset is increasing. When asset is increasing, it takes a debit balance. Cash that went out. Cash is an asset. Cash is reducing. When cash asset is reducing, it takes a credit balance. So this is how we journalize this kind of transaction. The next example is when the expense is incurred. So when the expense is finally incurred, this is an expense for which it was prepaid. It was prepaid and then later on it is incurred. So when it is incurred, expense will now be recognized and then the prepaid expense, which is an asset, is going to reduce. So expense will be recognized. Expense increases in expense take a debit balance, and then prepaid expense is an asset, and prepaid expense is going to decrease. So decrease in an asset is going to take a credit balance. So this is how we journalize this kind of transaction. Another example is when cash is paid on the day the expense is incurred. If cash is paid on the day the expense is incurred, it implies that we are going to recognize expense because an expense is incurred, and we are also going to recognize cash paid. So expense and cash will be the two accounts that will be affected. So expense is going up because cash is paid on the day the expense is incurred. When expense is going up, it takes a debit balance. Cash is paid, cash is going out, cash is an asset. When asset is decreasing, it is going to take a credit balance. All right, the next example is if cash is paid after the company receives goods or services. So the company receives goods or services, but there is a promise to make payment later on. So that is a liability. And those kind of liabilities, they are called payables. They are called payables. The company received these goods and services and make a promise to pay later on. So the expense account is being recognized, and a liability account known as payable is also being recognized. Expense is going up. When expense is going up, it takes a debit balance, and then we have a liability, which is a payable. Liability is going up. Increases in liability based on our role takes a credit balance. So expense is debited, payable is credited. So this is a case, another example when cash is paid. So there is a payable there's a payable, which implies we are owing somebody. We bought something or we received something on account. So we recognize expense as we saw in the previous example and the payable. Now we finally make cash payment. Once we make cash payment, the two accounts that will be affected is the payable. So our liability is going to go down, and then cash is going out. So cash is also going to go down. So the payable is a liability. When liability is reducing, it takes a debit balance. And then we have cash. Cash is decreasing. When cash is decreasing, it is going to take a credit balance. So we have actually recognized different accounts, and the broad category of all these accounts are assets, liabilities, stockholders' equity, and the two types of stockholders' equity is contributed capital and retained earnings. So these are actually the rules that we follow when we journalize transaction. So notice we have said increases in assets take a debit balance. So you see debit for increases. So increases in assets will take a debit balance. For liability, increases in liability takes a credit balance. And for stockholders' equity, increases in stockholders' equity take a credit balance. So on the T account, on this side, the left-hand side is the debit side, the right-hand side is the credit side. Left-hand side on the T account, the debit, and the right-hand side is the credit, and so on and so forth. So that is why we say increases in asset takes a debit balance, increases in liabilities take a credit balance, increases in stockholders' equity takes a credit balance, and stockholders' equity is made up of contributed capital and retained earnings. We introduce ourselves to two new accounts in this chapter, which is revenue and expenses, because these are the accounts that will end up in the income statement. And for revenue, we said increases in revenue is going to take a credit balance, whereas for expenses, increases in expenses take a debit balance. So those are the rules that are required in journalizing transactions. All right, now we are going to look at more specific types of transactions. The first one we want to look at is Chipotle purchased food, beverages, and packaging supply costing $207,700, paying $176,700 in cash and owing the rest on account. So notice that when they bought food, beverages, packaging supplies, these are all supplies, so it is for this amount. So the supply account is going to be affected, and then they paid a certain amount in cash. So cash account will be affected, and then they owe the rest. So that will be an accounts payable. An accounts payable is a liability. So in journalizing this transaction, we follow the rules. So supplies is an asset for this business. Asset is increasing. When asset is increasing, it takes a debit balance. And then we have the cash that was paid. So cash is going out. So cash is reducing when it is going out. So when asset is reducing, it takes a credit balance. And the remainder, which is the difference between the 207,700 and 167,700 is $40. And that $40 is accounts payable. Accounts payable is a liability. So liability is going to increase for this company because the company is owing another business. Increases in liability takes a credit balance. So this is how we are going to journalize this transaction. After a journal entry, we need to be sure that the accounting equation balance. So we are going to come to the asset side and we state all the asset account. We have supplies, that was a debit, so it is positive. And then we have cash. Cash went out, so it is negative. And then we also had accounts payable, that is a liability account, which increased by $40,000. So when we say the accounting equation must balance, we imply that the left-hand side of the equation must be equivalent to the right-hand side. So when we sum this up, we will have 40,000, and on this side is also $40,000. So the balance sheet equation balances. And then the last thing we need to do is to post this transaction to their respective T account. So we have cash accounts, supply account, accounts payable. So these are the three accounts that are affected. So all we do, there was a previous balance on the cash account. The cash account took a credit balance, so this is going to go on the credit side. And then the supply account already had a balance. As far as supplies is concerned, we had a debit, so this amount is going to come to the debit side. And then the last account is the accounts payable. So we had a previous balance. After this transaction G, accounts payable increases. There was a credit of 40,000. So when we post to the T account, it will go to the credit side of the T account. Again, for every T account, the left-hand side is the debit, the right-hand side is the credit. The left-hand side is the debit, the right-hand side is the credit. So we just post accordingly from the general ledger, from the general entry to the general ledger. All right, let's look at another example. It says at the beginning of January, Chipotle paid in advance. They paid in advance 36,000. So they paid in advance. This becomes a prepaid expense, which is an asset to the company. So Chipotle paid in advance 36,000 for 6 months of rents, 32,000 for insurance coverage for all of 2012, and 18,000 for advertising over several upcoming months. So the two accounts that are affected will be cash and prepaid because they are paying with cash. So cash is an asset, prepaid expenses is an asset. So we are going to sum them up, which is 36 plus 32 plus 18,000, and that becomes 36,000. So prepaid expense, which is an asset, asset is going up, asset prepaid expense is going up, so it takes a debit balance. And then cash is also an asset, but cash is going out. So when asset is reducing, it takes a credit balance. So this is how we are going to journalize this transaction. Then we need to check to be sure that the balance sheet equation is balanced. So there are two asset accounts, they cancel out, which implies that on the left hand side we'll have 0 and on the right hand side it will remain 0. So the accounting equation balance. The last thing we do is to post this general entry into the general ledger on the different T accounts. So the two accounts, cash and prepaid expense. The cash was credit balance, so the T account posting, that will come on the credit side, and the prepaid expense was a debit balance. So when we post to prepaid account, that will come on the debit side. All right, let's look at another transaction. This is during the first quarter. Chipotle sold food to customers for 619,300. 4,000 was sold to universities on account. So an account is to be paid the next quarter, and the rest was received in cash in the store. So there are three accounts that are affected here. So revenue needs to be recognized. So there is a revenue account, there is the cash account, and then there is the receivable because sales was done on account. So the university promised to pay the next quarter. So Chipotle sold food to customers for this amount, and then 400 was on account. So from this total amount, which is 619,300, when we subtract the 400 that was on account, which will be account receivable, it implies that the balance is the cash they receive. So cash is an asset. Asset is increasing. It takes a debit balance. Accounts receivable is an asset. So the company has in their hands somebody promising to pay in the future. So it has future benefits. So accounts receivable is an asset. Asset is increasing. It takes a debit balance. And then we have restaurant sales revenue, which is increasing. When revenue is increasing, it has a credit balance. So this is how we are going to journalize this transaction. Then we ensure that it is balanced and we post them on their respective T accounts. All right, the next transaction we want to look at is say Chipotle paid 49,300 for management training expenses. So this is part of general and administrative expenses. So this is an expense. Expense is going to be recognized and they are paying with cash. So our cash account will also be affected. So what we find is that expenses is going up 49,300. So it is going to take a debit balance based on our rule. The role we say for expenses, increases in expenses take a debit balance. So in this case, the expense that is going up is the general and administrative expense. It takes a debit balance. Cash is an asset. Asset is reducing because cash is going out. So that is going to take a credit balance. So that is how we journalize this transaction. We check to be sure that the balance sheet equation balances, and then we post them on their respective T accounts. All right, let's look at another example. This says Chipotle paid employees who worked this quarter for 138,600 and last quarter for 91,500. Recorded last quarter as a liability in accrued expense payable. So last quarter, some money was due to employees, but it was not all paid, so it became a payable. The business promised to pay in the future. So now part of that money has been paid. So the three accounts that will be affected will be a salary and a wage expense. It will be accrued expense payable, the liability that the company had incurred. That liability is going down because the company is now making payment. And of course, cash account, because all of this is done through cash. So let's start from the salary and wage expense. Of course, for this quarter that the company makes a payment of 138,600. So salary and wage expense. Expense is going up. Increases in expense take a debit balance. Then we also had a liability that the company is paying off. That was The liability is 91,500. So liability is going down. The precise liability is accrued expenses payable. When liability is going down, it takes a debit balance, and cash is going out. Cash is an asset. So cash is going out. It means that asset is decreasing. When asset is decreasing, it takes a credit balance. Now we are going to ensure that the balance sheet equation balances. In other words, the left-hand side of the balance sheet equation should be equivalent to the right-hand side. And then we post all this transaction to their respective T accounts. So we maintain, if they have a debit, they are going on the debit side of their T account. If it is a credit balance like cash, which is a credit balance, so it is going on the credit side of the cash account. All right, more examples. Chipotle sold for cash land, so included in property and equipment. So this land was recognized before as property and equipment. So it's costing 11,900 at a loss of 1,300. So three accounts are affected. There is cash because they sold the land cash, so cash is coming in. Cash account will be affected. Okay, then there is a loss. There is a loss which is an expense. It's costing the company. Disposition of assets, so it's an expense that needs to be recognized because they make a loss of 1,300. And then of course there is property and equipment, which is the land, which is an asset, but that is going out because they sold the land. So this is how we recognize this transaction. We have cash. Cash is an asset. Asset is increasing. It takes a debit balance. The loss on disposition of asset is an expense. Expense is increasing. When expense is increasing, it takes a debit balance. And then property and equipment is an asset that is reducing because the land is sold off. When asset is reducing, it takes a credit balance. After we journalize this transaction, we ensure that the balance sheet equation is balanced, and then we post them to their respective T accounts. Another example, Chipotle received 3,300 cash from customers paying on their account. So this is customers paying on their account. The company is receiving cash. So cash account will be affected, and the accounts receivable will also be affected. The company had accounts receivable before because their customers had a promise to pay. So they had taken goods from the company with the promise to pay. So the company had established an accounts receivable, which is an asset. They are expecting payment in the future. So when the customers now make payment, cash is coming in. Cash is an asset. So it is recorded on the debit side, 3,300. Accounts receivable is going to reduce, is going down. Accounts receivable is an asset. Asset is going down. That transaction is recorded on the credit side. Now we ensure that the balance sheet equation balances, and then we post these journal entries to the respective T accounts. All right, another transaction is during the quarter, Chipotle paid supplies 37,200 on account. If they are paying on account, they are paying with a promise. During the quarter, Chipotle paid supplies of this on account. All right, so this is different. They are paying something that they had on account. In other words, Chipotle had taken supplies on account, and they are now paying for those supplies. So, which implies when they took supplies on account, they had a payable which was a liability. Now they are using cash to pay down their liability. So we recognize liability that is reducing. Accounts payable is a liability. Liability is reducing. It takes a debit balance. Cash is an asset. Cash is reducing because they are paying off their liability with cash. So it is going to take a credit balance. Then we ensure that the balance sheet equation balances, and we post this on their respective T accounts. All right, another example. It says during the quarter, Chipotle incurred and paid $10,000 for utility, part of occupancy expense. So it's part of occupancy expense. So this will be an expense. So expense account, occupancy expense is going to be affected, and by 10,000. So straight away, expense is going up. When expense is going up, it takes a debit balance, 10,000. The question continues. It says, and so during the quarter, Chipotle incurred and paid 10,000 for occupancy expense, and they also paid 48,600 in maintenance of its facility, part of other operating expense. So this is also operating expense. Operating expense is going up. It's going to take a debit balance, and the company is making cash payments. So when we add all of this, is equivalent to 58,600. Cash is an asset. Asset is going down. It is going to take a credit balance. Then we ensure that the balance sheet equation balances, and then we post this transaction to their respective T accounts. All right, another example. Chipotle received 4,700 cash as investment income earned during the quarter. So they are receiving cash. Cash is an asset, and they receive that as investment income. So that will be a revenue. So cash is an asset, money is coming in, so asset is increasing, it takes a debit balance. Investment income is a revenue is increasing, it takes a credit balance. And then the balance sheet equation balances, and then we post to the respective T accounts, the cash account and the investment income, which is a revenue account. All right, another example. The good thing is, in the multitude of this example, we tend to really understand how we journalize these kinds of transactions. All right, it says during the quarter, Chipotle sold gift cards to customers for 15,400 in cash, expected to be redeemed for food next quarter. So once they sell gift card, they are receiving cash. So cash account will be affected, but that becomes an unearned revenue, which is a liability. It's an unearned revenue. Unearned revenue is a liability. It will only become revenue when the customers present this gift card for exchange of goods and services. So asset is increasing, which is cash. When asset is increasing, it takes a debit balance. Unearned revenue is a liability. When liability is increasing, it takes a credit balance. Again, the balance sheet equation balances, and we post to the respective T accounts. All right. So now we can actually sum up all the T accounts we have for all the transactions that Chipotle have incurred over the year. So when we sum accounts, respective T accounts, we are adding up all the debit side, and we are also adding up all the credit side. So when we do that, the side that is greater will have the balance stated. So on this side, the balance for the cash account is going to be a debit balance of 370,000. If we look at the note payable, for example, on the notes payable, we have notes payable is a liability. When we add it up, we have a credit balance of $233,200. So see, this will remain as a credit balance. So when we have all the T accounts, what we have done is that we have isolated T accounts that will go to the balance sheet. So on the balance sheet, we have assets, liabilities, stockholders' equity. So notice that here we have all assets account. Cash is an asset account, short-term investment assets, accounts receivable, supplies, long-term investment, property and equipment, prepaid. So these are all assets. Assets go to the balance sheet. Then we also have liabilities account. Liability accounts will end up in the balance sheet. Accounts payable, accrued expense payable, dividend payable, unearned revenue, notes payable. Then we have stockholders equity account, common stock, additional paid in capital, retained earnings. So we isolate these accounts because these balances will be transferred to the balance sheet. We also isolate accounts that goes on the income statement. We saw an example of an income statement. So largely we'll need revenue accounts and expenses. So restaurant sales revenue is a credit balance. Investment income, a credit balance. So these are revenues. So you notice these are expenses below. Salaries and wage expense, occupancy expense, other operating expense, general and admin expense, loss on disposal of an asset, which is an expense. So the whole idea in this chapter is to be able to recognize operating decisions when the company makes operating decisions, how those are posted on the T account, and they are posted on the T account from the journal entry. So journal entry, so the original transactions find themselves on the journal entry, and then from the journal entry they are posted on the general ledger. Then we isolate accounts that need to go on the income statement, and we'll take these respective balances and the accounts to the income statement. So when we develop an income statement, what we need is simply revenue and expenses. So the whole idea is to take revenue minus expenses so that we end up with the net income. We have discussed these other accounts. Balance sheet, asset is equivalent to liabilities and stockholders equity. Statement of stockholders equity will start with beginning retained earnings plus net income. So the net income from the income statement is going to go into the statement of retained earnings minus any dividend that was declared, and then we'll also have ending retained earnings. Statement of cash flow is actually arranged based on operating activity, investing activity, and financing activity. Again, in this chapter, our focus is in developing the income statement. So we'll need revenue account balances and balances of all expenses, so that we can be able to compute the net income. All right, so we had already discussed before how these statements are related. Net income is going to move to the statement of stockholders' equity. Any retained earnings is going to move to the balance sheet, and the cash, change in cash in the statement of cash flow is going to go to the asset side of the balance sheet. So from all those balances, we are going to build a tri-balance. A tri-balance, which is the first stage towards building our income statement. So on the tri-balance, all the accounts are stated, and then if they had a debit balance, they go on the debit side. If they had a credit balance, they go on the credit side. Let me go backward and then look at one account, and we'll see where that account falls. So I go backward. Let me look at cash, for example. So notice that cash have a debit balance of 370,000 debit balance. So when we move this to the tri-balance, so under cash, we are going to put it on the debit side of the tri-balance, 370,000. And we do the same for every account. So notice cash, 370,000. It was a debit balance, so it comes on the debit side of the tri-balance. And at the end of recording all these respective accounts and their different balances, what will happen is that the debit and the credit side is going to be equal. So from the tri-balance, we can now form our income statement. So the income statement, we are going to begin with the sales revenue. So we'll begin with the sales revenue, and then we'll bring in all the different expense account from the tri-balance in order to form our income statement. 619,300. So notice this is restaurant sales revenue, 619,300. So sales revenue, and then all the expenses will come under. So sales revenue, and then these are expenses, food and beverage and packaging. There was a salary and wage expense, occupancy expense, other operating expense, depreciation expense, general admin expense. We take all the balances, so we have total expense. When we take our sales revenue minus the total operating expense, this is what we have, which is income from operation. Then we are going to subtract other expenses that were mentioned, which is not coming from operating activity above, such as investment income and loss on disposal of assets. So we are going to end up with the income before income taxes. Then once we pay taxes, we end up with a net income. So this is really how the income statement is designed. So transactions occur, we journalize those transactions, then we post those transactions on the general ledger to those different accounts in the T accounts, those different T accounts. Then we take the balance of those T accounts to a trial balance, and then we go to those trial balance and we leave out revenue and expenses to form our income statement from which we can have our net income. So at the start, this is a complete income statement that we had at the beginning of the slide. Once we have an income statement, it can really give us information about profitability. So there are different profitability ratios that we can compute. One of them is what we call the net profit margin. In computing the net profit margin, it is simply going to be the net income divided by the net sale. So the last income statement I just projected, this one, as I go back, the net income is 215,000, and then the net sales, so the sales revenue is 2.2 million. So when we bring it here, 215 divided by 2.2, we end up with 9.47%. So that will be the net profit margin. So the higher the net profit margin, the better for the company. It suggests that the company is doing well profit-wise. That is the end of chapter 3. I've just looked at some key things that will really help our understanding of this chapter. Thank you for watching.